As we move into the panel discussion, we'll also have a poll popping up for the participants to quickly give their input as well. But without spending too much time on it, maybe I get two panelists to the conversation as well. Mahesh and Krishan, hearing the global outlook here and also what it means from the local economy, from the governor. What are your initial thoughts in response to what you're hearing from the economists, from a business perspective? Maybe you could touch on the resilience angles in the last 6 to 8 months and the outlook and how that's shaping each of your respective businesses. Mahesh?
I am really encouraged to observe the importance that is being given by the country to exports. And I say this because I've spent my entire professional career as an industrialist, as a manufacturer, and as an exporter. We have, over the years, created many jobs, created employment for thousands in Sri Lanka and other parts of the world. And in addition, impacted the livelihoods of these people, their families, and their communities. So to be able to uplift the lives of people who are impacted by this pandemic, I think one of the areas that the country really needs to focus on is the export sector. That has to be a key element of our roadmap for our strategy. And I was very encouraged to see that it's a priority of the president. I was encouraged to see that it's a part of the document that was presented by Dr. Hans. And so I see this as one aspect of the strategy going forward that is important for us to take into consideration.
Thanks, Mahesh. Krishan?
Okay. Just to endorse some of the comments made by Eric and the governor, we have a spectrum of businesses being a conglomerate. And if you look at how we were impacted in the last 6 months, tourism, of course, with the airport being closed, has been badly impacted. But the other businesses, the governor mentioned about the impact in April during the lockdown, but the quick recovery after that. Yes, in April, across the businesses, whether it was the supermarkets, our consumer business, the Colombo port, and the Colombo port really being impacted because the transshipment volumes to the region were impacted with the lockdowns that they saw in April and May. But we were lucky that there was no community spread in the country. And as the lockdowns were eased, if you look at our consumer businesses, the supermarkets business, there was a very quick recovery. And as the governor mentioned, a return to near normalcy from June. The port, as well as activity returned to normal in Sri Lanka and in the region, domestic volume and transshipment volume picked up to near normalcy. So very resilient in that sense. And we've been lucky also that business activity was able to return to normalcy because we didn't have a spread. If you look at the last 6 weeks, again, not as strict a lockdown as we saw in April, clusters and certain zones. So impact has been much less than April, but there has been an impact, of course. Even the tourism business, while there were no tourists, the hotels were seeing good local business in August, September. Weekends, we had high occupancy in the resorts, the restaurants in the Colombo hotels. and the banqueting business had recovered to, in fact, even better than normal. So this recent second wave has impacted that. But again, with some of the lockdowns being removed, we are seeing the businesses come back. Then Eric mentioned this outlook for 21 and that it could be a post-war kind of recovery. I mean, if I look at our forward bookings, we have 4 properties in the Maldives and all the hotels in Sri Lanka. Because of the pent-up demand, the forward bookings for March, April are better than what they were in September, October last year for 2020, March, April. So what I can see is with the vaccines coming in that we could have a rapid recovery in tourism, and with some of the other stimulus measures for the local economy, the consumer side and local economic activity can also recover quite rapidly. So my outlook is quite positive.
Thanks, Krishan. Eric, I think in his presentation outlined some of the changing trade dynamics, Mahesh, and in particular, Asia sort of now being the more central stage for both growth and trade. As a business which is really exposed to the global consumer through global trade shifts, um, how are these trade dynamics impacting you as both a local company as well as having overseas operations as well? And what are some of the things you're hearing from your customers? Is it really ringing some of the trends that Eric and other forecasters are talking about?
I think what was encouraging to listen to in Eric's presentation is the rebound of exports, especially from the emerging economies. I hadn't noticed that significant rebound, honestly, certainly not from Sri Lanka. However, listening to Eric's presentation and understanding what's happening with respect to the rebound of exports and through these economies gives us a lot of confidence that there is an opportunity for us to be a part of it. Now, with the pre-COVID environment, where there was the trade conflict between the US and China, a lot of the economies like Vietnam, Indonesia, and Bangladesh benefited meaningfully. We didn't benefit as much through that. However, with the environment now, it does appear that some business is moving across in our area. What is probably encouraging is that customers are looking at verticality in their sourcing, right? So from a global sourcing network to looking at verticality. So it is important for us to have that verticality in region. The other piece is because they are unable to open their stores and continue with the same level of traffic through their physical stores, a lot of their business is going digital. And for us, we're seeing this huge trend of looking through a digital lens. So even from product creation through to approvals for the product that is created, right through to manufacturing, there is a strong focus on digital technology and digitization. So we see this not only on the side of the customers, but there's a need and an acceleration of digitization, even in manufacturers in the region.
Thanks, Mahesh. Part of the economic revival is also the consumer aspect and the domestic consumer, given about 70% of the GDP is from the domestic side. Krishan, as a company that's exposed to the consumer, and you have a lot of supply chains which feed into even the SMEs and some of the mid-tier companies as well. What are they feeling right now? Are they optimistic about some of the growth prospects that the policymakers and government is talking about, or right now they're still in the resilience mode?
I think given the uncertainty, because the pandemic is still with us, I think most businesses are in a resiliency mode. But if you look at that period from end May till the recent wave and the kind of consumer activity we saw, it was much stronger than what we've seen for a few years because of some of the stimulus measures that were introduced pre-pandemic. So the tax incentives, the lower VAT and other stimulus measures, they started to kick in before the pandemic. Then there was a shock to the system. Then as the lockdowns were eased, we saw a quick return to pre-pandemic volume levels, which are better than what we have seen for about 2 or 3 years until early this year. So in that sense, there is optimism now as the pandemic hopefully leaves us, then there is optimism that business could be better.
Right. Shifting from the business perspective to maybe back to Eric. You mentioned in your investment thesis or theme, Eric, just maybe keep your speaker slightly lower. There's a question coming in as well. Given the low level of interest rates and the level of money being printed, how soon do you think money will flow into emerging markets? And in that scenario, do you think countries like Sri Lanka will be able to benefit? Or is our current credit rating sort of a deterrent or an outlier in that investment thesis?
So thank you everyone for the questions. I think before we can answer the outlook about how quickly capital will come back to emerging markets, I think the first thing we have to remember is that emerging markets, broadly speaking, have suffered outflows for the better part of the last 7 to 10 years, right? So it's not just a COVID scenario that has weighed on flows. Let me just give people an interesting statistic that they may or may not be aware of, which is over the last 10 years, if you compare the S&P 500 in the United States with an emerging market equity index, the S&P has outperformed by 100% in 10 years. That's 10 percentage points per year, excluding dividends. Now, that's just one example, but I think everybody, would understand that when you have that kind of a persistent trend of relative performance, that tends to be a drag on capital flows. Now, again, that's just one aspect. That's just portfolio flows. That's not FDI and other forms of capital. But I think what we are seeing today is some very early signs of capital coming back to emerging markets. But what I would say is that capital is coming back in almost a hesitant fashion. And while I'm extremely optimistic that those capital flows will continue to build on themselves, I think investors will go back to the largest and most liquid markets first. And then as they just realize that they need a more diversified portfolio, they will start to expand and take more credit risk, more sovereign risk in an effort to achieve higher returns. And so I think, for a number of economies that have a challenging credit outlook, it will take some time before investors get comfortable. But we have to remember, global yields, global returns for both financial assets and businesses have collapsed. And so in some ways that makes more credit challenged economies and corporations in some ways relatively appealing for those who are willing to take credit risk. And we all know that, right? Whether you're an investor or the owner and operator of a business, in times like today, when people need to generate returns, they need to generate return on their capital, return on their equity, you have to take some risk. And so I do expect that capital to return, but I think it will take some time. I think it will be slow and hesitant.
And Eric, in terms of the sentiment from these investors, we saw post the global financial crisis search for higher yield and investors really flocking because of that. Do you think that will be a secondary reason? So markets like Sri Lanka, which might offer high yield, will not really be too attractive, as you said, because of the credit profile. So is it maybe 22, 23 onwards that we will see really markets like Sri Lanka benefiting, or do you think that could be a bit of spillover impacts?
I'm not sure it's easy to pinpoint what year or how long it will take. I think it will happen faster than many people assume. And it's for a reason that may not be immediately obvious. You know, we have to remember, and I'm sure everybody participating today does remember, that after the financial crisis 12 years ago, everybody discovered that the banks, quote unquote, were a big part of the problem, right? The leverage on bank balance sheets, the leverage in financial institutions. And so it was the regulators who said to all of the financial institutions around the world, you need to reduce your risk, you need to reduce your balance sheet. And that meant that the owners of capital benefited disproportionately because they weren't suffering those restrictions. Today, it's a much different environment, right? The banks are not the source of the problem. In fact, nobody is, right? I mean, it's a health crisis, right? You can't pinpoint that on a sector or an industry. And I think every government around the world and every regulator knows that if the global economy is going to recover, you need the banks to facilitate lending. You need the banks to facilitate liquidity to their onshore clients in both the corporate space and the investor space. And so because the banks are not constrained today the way they were 10, 12 years ago, I'm more optimistic about the return of normal financial market and economic conditions.
So thanks, Eric. Governor, if I bring you in at this point, I think you talked about the alternative policy platform that the government is bringing in, the debt profiling in kind of the local context of what we're doing in. And still, I think some of the rating agencies and some of the other forecasters are maybe not still really buying into that as yet. Maybe it's a while away. How does the central bank, through its policy measures, look to address that? Because given 2021, we have $1 billion maturing in July 2021, a stream of other refinancing during the year in terms of foreign loans. How will the central bank really progressively and the policymakers progressively look to address that gap between where you all are thinking and where they're coming from as well?
This is the argument which are frequently heard in the Sri Lankan discussions, particularly in the financial press. In these arguments, in fact, these arguments are there also. I'm living within those arguments in the central bank itself. These are arguments which can be strongly presented when one thinks of, one restricts one's arguments to financial sector flows, inflows and outflows. My feeling is that financial sector transactions are indeed extremely important and dominant in the current globalized situation. Even knowing that, I would expect the financial sector flows, inflows and outflows to be affected gradually by better performance of the real sector activities, exports and maybe remittances, and in the time to come, tourism, revival of tourism. For example, in the 5 months or 4 months or 5 months after the first COVID attack, exports became very strong. There were monthly exports have gone beyond the 2019 numbers in 4 or 5 months consistently. Remittances increased and went beyond 2019 numbers. And during this period, central bank was even purchasing foreign exchange from the domestic market. I think we purchased something like 500 million US dollars during this period. Things have obviously started worsening after the second attack of COVID. But I strongly believe that once the impact of COVID-19 is getting less, is getting under control, there will be a boost into real sector economic activities, which includes largely foreign exchange earning activities. There will be also, there are already signs of this. There will be also an improvement in the foreign direct investment scene. Portfolio flows might take some time to come to what was normal a couple of years ago. But direct foreign investments can start coming into Sri Lanka much more quickly than portfolio inflows. On the basis of these considerations, the central bank officially considers that we are not in that kind of desperate situation as financial press seems to depict. Okay.
Thanks, Governor. There's a couple of questions on the export recovery. Maybe if I ask Mahesh some of the questions coming in. How much of our export recovery is due to some of the overseas stimulus measures employed by governments to keep kind of the consumer together? And how much is it due to us really winning market share from competitors who were having lockdowns in their respective economies?
So that's a difficult question to answer in terms of giving a weightage as to how much is as a result of our own efforts as against the market itself. But clearly, after the first wave, which was a huge shock for the markets with the shutdown of the stores, and especially with the literally cease of demand completely. So that was a huge shock for the industry and for the market itself. As we eased off and as we understood what the trend was, as we managed the local situation and our customers managed their environment, and as digital sales picked up, we began to see that some of it was as a result of the fact that they have got their act together and their sales have come up mainly through a spike in digital commerce. And part of it is because we have reorganized ourselves, understanding what is important for us to do, what changes are taking place in the marketplace, what capabilities and muscles we have to build, and literally accelerating that process on our side in order to be able to serve the customer.
Thanks, Mahesh. I think you were talking about the inward-looking kind of things that companies and organizations really need to do at this time. Krishan, if I was to look at it from competitiveness and productivity and conversations around that. I know pre-COVID as well, these were conversations always had, but has those been really accelerated from the domestic, from a domestic point of view, and some of your businesses that are catering to the domestic consumer?
Very much. Just one example would be the supermarkets business. We were the only supermarket chain to have an online offering, but it was just a few orders a day, like less than 100 orders a day. Now, in the latest lockdown in October, we were catering to 10,000 online orders a day. And initially, when this happened in April, we were unable to cater because it was simply too much of a shock to the system. But we've had to accelerate the digitization drive that we had started. And as a result, we were ready in October to cater to that significant surge that we saw again with the lockdown. Similarly, even the tourism business, the shift to digital, although it has been, the airport has been closed, we have been able to spend the last few months focusing on that shift which we had started and accelerating that so that we are ready when the borders do open.
Eric, you spoke a few, some of the risks that could maybe dim some of the outlook or the positivism that's coming with the vaccines and things like that. Do you expect, for example, the geopolitical tensions between the US and China, do you expect it to dim down further? In that context, are countries like Sri Lanka positioned a bit more better and positioned in a better way? And what are some of the risks, for example, on key commodities like oil? Because that's a key fundamental part of Sri Lanka's import bill as well. Do you see better economic demand really being an upward, seeing oil going on an upward trajectory, or do you think it'll continue at seesaw at current levels?
Two excellent questions. And both of these topics weigh on our minds, fairly considerably, given the magnitude. The first one is with regards to US and China. It's my interpretation and our interpretation across my research teams that the Biden administration in the United States will take a much more constructive approach to global trade. And there's a number of reasons for that. One, I think he philosophically believes that global trade is an important engine of growth. It's an important way of maintaining both diplomatic and economic ties with historical US trading partners. And by the way, that includes countries like Japan, South Korea, as well as most of ASEAN and South Asia. And so from a purely big picture point of view, I would argue that a Biden administration is going to be much better for global trade and for those economies that are more, shall we say, traditional open economies. The other thing to keep in mind is that with a divided Congress in the United States, it will be more difficult for Biden to implement or execute domestic fiscal stimulus. And if that's the case, then external factors, so global trade, become a much more important leg of support for the US economy. So really two angles there. The one possible exception is China. I do believe that the Biden administration will continue to take a relatively hawkish stance against China from a geopolitical point of view. They want China to engage with the world in a way that offers a level playing field, both economically and geopolitically. But hawkish does not mean antagonistic. And that's an important distinction, right? You can be a tough negotiator without being random and unpredictable. And so I do think the US, even towards China, will find ways of reestablishing a point of negotiation. So we're relatively optimistic about what the new US administration will mean for the economies of Southeast Asia and South Asia more generally. On oil prices, I guess let me put it this way. Let me get the obvious statement out of the way first, which is that our base case, our published forecast is for oil prices to remain in a $45 to $50 range for the next 12 months. Now, I would also make the point that if the global economy improves at a faster pace than we expect, and demand for travel and tourism and all of these things picks up faster than we expect, then there will be not necessarily a demand shock to the oil markets, but certainly a demand impulse. And considering some of the supply that's been taken off the markets, I would argue that if your base case is $45 to $50 oil, then the surprise is to the upside, not to the downside. And so for importers of oil, I think there is a bit of a tail risk for 2021 of, excuse me, much higher oil prices. So it is something we need to be sensitive to or conscious of.
Thanks, Eric. We're, I think, just under 6 minutes in our session so far. So let me just bring a few final remarks from our resource personnel here with us today. Professor Lakshman, if I was to get to you as well, a lot of the questions coming in to the Q&A, as may be expected, is on the debt situation and kind of the risk mitigation strategies there. Given some of the risks that Eric said as well, and given some of the concerns that rating agencies have in terms of the interest component as a percentage of GDP, which is one of the statistics they do look at when comparing us to, say, other median countries within our ratings category. And also in terms of the monetary policy going forward as well, what steps will the central bank really do to reassure these concerns? Because I think part of the success of this economic takeoff will be that macro stability, and then providing that through monetary policy as well as mitigating our debt concerns are part of that. So any final concluding thoughts to address these concerns, Professor?
Whether I can say something which will alleviate all the people who are having concerns and problems is a difficult kind of proposition. But our strategy, I am sure, is going to pay off as we move forward after the end of this year, and then move into 2021. One of the factors we are depending heavily on in terms of government debt is to increase the proportion of domestic debt. When the domestic currency debt, if I may also use the term, in a country with sovereign powers of money printing, as the modern monetary theorists would argue, is not a huge problem. The debt can be rolled over. That is when it is mostly domestic debt. So what we are trying to do is to increase the domestic component of the total government debt. And we have already done that to a large extent, and we will go ahead with that policy framework. Foreign debt, we will not go for additional debt creating investments as far as is possible, but go for financing of investments in a non-debt creating manner. Hence the focus on direct foreign investments more than the portfolio inflows. These are the few things which I have to go on repeating, and also the significance of the real sector developments, which our panelists over there have also supported that argument that the real sector will come up strongly in 2021. So with that happening, debt issue, as people see it now, I am sure can be brought under control. Thank you very much.
Thanks, Governor. In your concluding remarks, both Krishan and Mahesh, we know some of the outlook. We don't have a crystal ball, but we have an idea of where we are going. The governor has sort of outlined how government's looking at growth and managing some of the debt risk. Given that stability or expected stability as business leaders, how do you expect to navigate your businesses through this some level of uncertainty, but also through a path to takeoff, which will be either led through growth or investment?
I think it's going to be important to stay very close to the market, very close to the customer, very close to the consumer, and understand exactly what's happening there in terms of what's driving the economy, what's driving their business, and building the capabilities that you require in your operation to be able to support and service them. I think that's important. The second piece is also really having a very strong balance sheet. Having financial resilience is going to be critical because you will have to take the best of opportunities that this environment will bring about. You will have to invest in capabilities, probably in some technologies as well. And having that financial strength to be able to do that is going to be critical and important. And the third piece is really operational excellence in terms of being agile, in terms of manufacturing competitively. I think those are going to be really critical because the uncertainty will continue, right? Both at our end and also in the market. And so being agile to be able to move almost on a dime and change course, pivot, and then respond to the change in the marketplace is going to be critical as well.
Thanks, Mahesh. Krishan, in 30 seconds, if I may ask.
Yeah, I agree with what Mahesh said. I believe we will have a V-shaped recovery, but it will take time. The next 6 months will continue to have ups and downs and a lot of uncertainty. For us, looking at tourism, we've lived through 25 years of war. As a big investor in hotels, we had the Easter bombs last year. So we've had a lot of uncertainty in the past as well. So, what Mahesh said, financial strength, agility, technology, competitiveness, all that, to focus a lot on that over the next 6 months. Be aware there'll be ups and downs, but beyond like mid next year, I am confident there will be a V-shaped recovery.
Thanks, Krishan. So with that, I think we'll bring this session to a close. Thank you to our two speakers, Eric and Professor Lakshman, for presenting your thoughts, taking some of the hard questions, and to Mahesh and Krishan as well for really bringing in that business perspective as we look at the local and global economic recovery. Thank you to all the participants for sending in your questions, and back to Savitri.